Welcome, everybody. I'd like to welcome back to the program Tyler Wood from the Chartered Market Technicians Association, or the CMT. Tyler, welcome. It's December. How are you?
I'm doing great, Andrew. Good to see you. Happy holidays.
And happy holidays to you. Let's start by a little discussion from a 10,000-foot view. We're hovering at record highs for stocks. Give us your sense of the overall health of the market.
Well, last time I checked, when markets are at all-time highs, that's not a bad thing. It tends to happen in bull markets, not bear markets. And last Thursday, we broke above that 6,900. What everybody is aware of is the fragility of this market. So we couldn't hold those highs. Friday was a sell-off, and we came into the week understanding that there's some weakness in the technology sector, which has been the leading group for most of this year. But we're 1,000 points higher than we were at the start of 2025 in the S&P 500, and that's not something to look away from.
How different does the stock market look today compared to a year ago? You say we've done 1,000 points on the S&P, probably 20%.
Mhm.
What does it look like in terms of leadership?
So coming into 2025, we certainly saw technology as a theme emerging, but we also saw a lot of concentration, narrow breadth. And so if I'm comparing mid-December to where we were at in the beginning of January and some of the fears about just how stretched and thin the leadership was, I don't see that right now. We've had a broadening, not just across all sectors of the market, but also across the technology sector itself. And we're seeing broad-based participation up and down the cap scale, which is a very healthy sign.
I was just going to come on to the dominance of AI. Isn't this repricing of big tech somewhat healthy?
Yeah, great question. So we held a conference for global investors in Dubai about a month ago. And one of the discussions that really resounded to me was the idea of this AI bubble. And we lined up a number of CMT charter holders and really prominent investment managers and strategists. And they said, "Oh, there's a bubble? Show me where it is. Like, I'm running towards it, because you can make your career in a bubble if you understand what you're doing." So let's break that down. The structural elements, right? Maybe what Dave Lundgren has referred to as the fundamentals bubble, meaning we're still seeing earnings beats by companies like Nvidia. That's a wonderful sign. But we also know that the forensic accountants, the Michael Burrys out there, have noticed the circular financing, the same sort of elements that were present in the late 1990s with the dot-com bubble. So knowing that there is that kind of concentration, knowing that we have some circular financing happening, that's not the trigger. That's simply the ingredients for this bubble. And what the commentary from our conference several months ago was that most human beings tend to underestimate what technology can do in the long run, right? So the internet is still around. There are plenty of dot-com companies that went out of business in 2001. But the internet has changed life as we know it. And so to understand that artificial intelligence and all of the expressions of what this AI revolution might do for our day-to-day life, for business practice, for efficiency, that is really hard for us to comprehend. But in the short run, we tend to overdo it. We get excited. But what you tend to see is that Wall Street analysts underestimate what these companies can do. And quarter after quarter, they're beating analyst estimates. That's what we're seeing right now. And finally, the analysts on Wall Street will start to price these securities so much higher that they can't beat earnings estimates. And you'll see this slew across the dominant names where we just have earnings misses quarter after quarter. And that's sort of the fundamental downfall to what was a bubbly bull run. For us in the technical field, we're waiting for a trigger. Even if we know that there is a bubble happening and this is not sustainable, you still have to participate on behalf of your clients or your firms. You can't, because of your personal bias, decide to sell out of these things early. You wait for technical levels to be broken, for securities to start trading below their 50 and 200 period moving average, to break key levels, all of the traditional signs and triggers that we would use to know that indeed the selling is beginning. We're not seeing that yet.
Well, how does the technical analysis toolkit have us navigate a bubble if and when it happens?
So there are a couple of sides to this equation. One is you can spot when securities prices start to move parabolic. And there are tools like parabolic stop and reverse, PSAR, is a tool that you can put on any chart of any security to start to see when things get extended to the upside or over accelerating. That's typically a time where it's going to struggle to make meaningful moves higher, continue to make those kinds of gains. Similarly, there is no better toolkit for risk management, right? To be objective, to remove your emotions from the decision, than looking at the information the market's giving us. So when price breaks key levels, when you start to see trend conditions breaking down or moving lower, reversing into downtrends, those are all different tools that you can use to get out of a bubbly bull market when indeed the party has come to an end. So I love the analogy that many of the analysts and strategists use. You want to go to the party. You just want to keep an eye out for when the punch bowl is emptying out, when the only people who are left at the party can't really dance anymore. It's no longer fun, and the cops are going to break this up pretty soon. You want to leave before those cops arrive. And that's the idea behind having objective levels for exits.
Tyler, one question that I always know I'm going to ask you whenever we speak is about the health of the small cap sector. It's like we had kids at school and I'm obliged to ask, how's Russell doing?
Let's see, we've struggled to pass the third grade a couple of times, I think. But what I'm seeing right now on the Russell 2000 is a healthy breakout, or retesting that breakout level in terms of price action. But the trend conditions in my work are very healthy. And we're seeing momentum sort of test that neutral level where when we see momentum resurging in the direction of the underlying trend, the price, that's really the condition that all trend followers are looking for to confirm that indeed this move has a sustainable characteristic. It's very constructive. The other thing that I would note, Andrew, is it's important to look at equal weight versions, even of the S&P 500, when we want to take a look at how the average security is performing and not just the leading mega cap technology, Meg 7 names. Looking at an equal weight version of any of the indices that you track is important. When we see that heavyweight leadership start to struggle, it's going to put pressure for any of the other securities in the index to hold up that cap weighted performance. So I would encourage everybody to get under the hood. It's not a stock market, it's a market of stocks, and there's a lot of opportunities out there.
2026 potential red flags that you're seeing right now? Any?
Well, you didn't say the Fed directly, but let's just go there because we got some employment numbers this morning. Today's December 16th, and the data had lapsed as the government was shut down. And what we saw was a surprise to the upside in the unemployment numbers. The markets were kind of pricing in about a 4.4%. I think we came in at 4.6. So unemployment rising. Well, what does that mean for the Fed in the scenario of our path for future rate cuts? Well, that's their dual mandate. They want to keep unemployment low, and a rise in unemployment, so bad news, can become good news in terms of the liquidity provisions from the central bank. The other piece of data that's coming out this week, which we haven't seen in a while, is CPI and inflation. And I think use whatever phrase you want, thread the needle, the balancing act, the tightrope walk that Chairman Powell is doing. We are expecting that the Fed will have more instructive commentary for us once we have some inflation data to pair with this jobs number. The path of rate cuts, I think, next year is one of the factors folks are going to need to keep in mind. So some of the smaller cap names that are more financing dependent, if we continue to see sharp moves higher in long bonds, that's going to be a headwind for some of those more debt dependent companies.
What are your reflections on the commodity market at this point? Anything jumping out to you there?
Lumber's still looking a little soft. We've had an incredible run in 2025 for precious metals. I know we don't make any investment recommendations on podcasts like this, but word to the wise, if everyone at the holiday dinner table is talking about, melting their grandma's old gold jewelry to sell it or buying more precious metals, it could be towards the end of that trend and that run. So I would expect that we're going to see some pullback in precious metals. Silver had an amazing catch up to gold just in the last 6 weeks, but I don't see those as long lasting trends. It's certainly not at the pace that they have been moving. The other side of the commodities market, and an important part of the inflation recipe, is the energy sector. And where crude oil goes in 2026 is going to be, well, I'm going to leave it to the experts in the commodities space. And for those of you who want to learn more about that, CMT Association is going to host a number of sessions specifically on commodities. January will be metals and minerals. February, we're going to be talking about commodities. And in March, we'll dig into the agricultural landscape as well.
From a sector stance, Tyler, where is the future juice? And can you name a couple of sectors that you expect to lag going forward?
So I spent a lot of time looking at relative strength. So the leadership groups in 2025 have really just been technology, and we've seen a little bit from healthcare, which has been kind of an interesting runner-up. Technology has turned lower in terms of its relative strength trends against the S&P 500 index, but we've seen broad-based outperformance from lots of other sectors. So even communications and consumer discretionary starting to peek their heads out. We've seen financials and industrials do really well in the last few weeks. So these are new emerging trends. And healthcare continues to be a strong outperformer, which I think bodes well going into 2026, that you've got more rotation, more participation, and not such a narrow leadership group. And I just refer back to that comment about a cap-weighted index. If we're seeing that those leadership names in the mega cap tech category struggle, even with strong performance from lots of other securities, because it's a cap-weighted index, you might not see it show up in the S&P 500 or the NASDAQ 100 itself, but look to those names individually or to the sector and industry groups to find those opportunities.
Brilliant. Thank you very much for joining me today, Tyler Wood. It's been a pleasure, and just wishing you and your family a happy holiday season.
Thank you so much, Andrew. Hopefully we'll get to start the new year off in style in a sunny Florida environment with a bunch of technicians and find out where this year might take us.
Yeah, heading to Tampa, right? January 6 and 7?
That's the next big CMT Association conference. Every winter, we try to get out of the Northeast and get together with some wealth managers in Tampa, Florida. That's January 7th through the 9th.
Brilliant. Thanks for joining me, Tyler. And to the audience, thank you for joining us today. And don't forget, if you enjoyed today's episode, please do subscribe wherever you download your podcast from.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com.